Hello traders and welcome to the London Forex Broadsheet's daily video wrap of the markets for Tuesday, July 15th. Exactly as we commented on yesterday, we saw the test of 1.6050 and we saw the failure to follow through. This has created a trend line confirmation that tells us we have resistance at that area. Getting through it will be hard. The test also created a reversal candle on the daily chart. The pair closed lower than it opened, and after a big move higher earlier in the day, that could create some volatility and a technical test of the lower trend line at 1.5750. The ZEW indicator of economic sentiment for Germany decreased by 11.5 points to negative 63.9 today. According to the ZEW report, the high oil price, the strong euro, the crisis in the United States, the interest rate increase by the ECB, and weak domestic consumer demand should negatively affect German companies in the next 6 months. Once oil began its fall on speculation that demand would slow, the euro-US dollar made a complete turnaround and fell as much as 0.8% off the daily high. On the cable today, the pair failed dramatically in its ability to hold and test the 2.0160 area. What was it doing up there anyways? After getting the momentum from the London market open to hurdle the 200-day simple moving average and make a dash for the hills, the pair proved once again that not being linked to a commodity really can create some wild rides. These parabolic moves tend to get reversed quite quickly, and now that traders have seen that there are no buyers in front, we may get a technical test of the sellers sitting at the lower trend line. A move to 1.9800 may be favored now, that is if the dollar can find some buyers. The pound reached the highest level against the dollar since March 26 after the Office for National Statistics said the UK CPI rose 3.8% in the year to June. This is the highest rate since official records began in 1997. The high rate of inflation, which the BOE projects will last well into 2009, is likely to prevent the bank from cutting borrowing costs even as the housing sector threatens to push the economy into a recession. On the Aussie, there looks to be enough momentum to keep looking at the long side, and now that new all-time highs have been set, we may see buyers resolve to get this to parity. Be careful though, this is a trending pair. It gets there slowly but surely. It does not race ahead of itself too much. Look for a little pullback to support before going long on it. Gold going lower will not be helping the pair. The Aussie also came within 150 pips of parity today, but as with other major currencies, fell once the New York session got going. On the loonie, we have a daily chart swing point forming, and may now see a move higher that retraces the recent selling. We can't get too excited about the pair, it has gone nowhere for months and months. The loonie did manage to beat parity by about 25 pips, but rose after oil's $6 per barrel fall, meeting resistance at 1.0025, which also corresponds with S2 of the LFB pivot points. On the Swiss franc, the pair broke the lower band of the daily chart pennant, and then failed dramatically at the breakout. We now can see that a swing point may have formed on the pair, and can also see that 1.0150 may be an area to break back higher through. The moves will be led by the equity markets. If they are green overnight, then look for a technical long test. We can see two strong technical candles, one bullish from yesterday and one bearish from today. That in itself sums things up, and it confirms that we really need to be looking at the long side of things. Come on, dollar baby, you can do this. The yen made a bearish pin bar at the close of Monday's New York session, and then followed through on the move on Tuesday, in Asian and European trade. The dollar did manage a 0.4% rebound on the yen during the New York session as equities staged their dramatic comeback. Our daily chart trendline was broken at 105.80 and the pair held lower. This was a big break lower and broke a trendline that had been held since early March of this year. The technical consequences now will be that the same breakout will create an upside roadblock going higher. Take care with this one. It will have to be backed by positive equities to get higher. It will not break if stocks are staying lower. On the upcoming economic calendar, it is dominated by CPI releases, Mr. Bernanke talking, and the FOMC minutes. Whew, this is a heavy week of economic data. We will see the reactions in the charts all week to these releases. In the Asian equity markets, Asian stocks fell for a second day in a row overnight. The MSCI Asia Pacific Index lost 2.2% to 129.49, the lowest since November 20th, 2006. In European markets, stocks paired declines after oil prices dropped more than $9 a barrel. The DJ Stoxx 600 lost 2.2% to 266.51, which means it's now fallen 33% from the June 2000 peak, although it did manage to partially recover from an earlier 3.3% loss. The UK FTSE 100 retreated 2.4%, while Germany's DAX lost 1.9% and France's CAC 40 slipped 2%. All in all, a terrible day to be a stock trader in Europe. On Wall Street, stocks closed lower after first posting triple-digit gains as concerns grew regarding the regional banks in the wake of the IndyMac Bancorp failure, the third largest in U.S. history. At the close of floor trading on the New York Stock Exchange, the Dow was on 11,510. The broader S&P 500 fell 11 points, or 0.9% to close at 1228. This is the lowest level since 2005, while the Nasdaq suffered the worst percentage loss of the day, of 1.2% to close at 2212 after a loss of 26 points. One concern troubling investors is the perceived ability of federal officials to bail out troubled institutions. They have been spread thin at a time when other firms may be on the brink of insolvency. Overall, concerns that mounting credit losses will create a banking crisis, along with a growing perception that the government's plan to backstop Fannie Mae and Freddie Mac will widen the budget deficit and increase the money supply, led to a broad-based sell-off of the dollar against a basket of the most widely traded currencies in the overnight session. However, sentiment did a 180-degree turn after Mr. Bernanke's testimony, which upwardly revised Fed projections for both growth and inflation in 2008 and 2009. Crude oil for August delivery fell $6.49 or 4.5% to 138.69 cents a barrel amid concerns that a slower U.S. economy will curtail demand for oil and gasoline. Oil dropped as Federal Reserve Chairman Bernanke said risks to growth and inflation have risen in testimony today to the Senate Banking Committee. Gold futures for August delivery climbed $5 or 0.5% to $978.70 an ounce, extending a rally to the highest price since March, as slumping equities and a sliding dollar sparked demand for the precious metal as an alternative investment.
All contents of the LFB are for informational purposes only and should not be used as a replacement for research by an individual investor, trader, or licensed investment professional. Neither the LFB nor any of its affiliates shall be liable for any errors, omissions, or for any actions taken in response to the information contained herein. We hereby make no representations or warranties regarding the accuracy of any information contained in this broadcast or on our site. Forex market trading involves special risks and may not be suitable for everyone. Each investor or trader should assess their financial situation and risk tolerance before proceeding. Copyright 2007, LFB Services, LLC. All rights reserved.